Good morning, Larissa.
Good morning, Joanne. How are you?
Very well, thank you. Good morning, everyone. Just join in there now. So we'll just get started. Are you okay, Larissa? Can you see the presentation all right as well?
Yes, indeed I can, Joanne. I'm just arranging my screens here,
Yeah,
so
just
just
give you a wee minute. Yeah, sure.
give me a moment.
Sure.
Here I do. Yes, go ahead whenever you're ready.
Thank you. So good morning, everyone, and welcome to our Navigating Growth CEO Insights for SMEs. My name is Joanne Creevy, and I'm a Client Services Manager at Canor Finance and Business Services. I'm joined today by CEO and founder of Canor, Larissa Feeney. Good morning, Larissa.
Good morning, Joanne. Good morning, everybody.
So Larissa is a fellow chartered accountant and also a lead entrepreneur for the Acorns program, as well as a contributor to the both Going for Growth and Ambition programs. Larissa is also a chair of the Donegal County Enterprise Board, a member of the Finance Subcommittee of the Atlantic Technological University, and the president of the Donegal Women in Business. So just a little about Canor. We are a firm of chartered and certified accountants, as well as company secretarial supporting businesses with their compliance, payroll, secretarial, bookkeeping, and tax needs. We are an award-winning practice, most recently awarded Online Practice of the Year at the and Client Services Award at the Irish Accountancy Awards. We also won Zero Partner of the Year for the fourth year in a row. We offer transparent fixed monthly pricing, and technology and digital processes are the core of our operations. We aim to streamline your accounting tasks, making them more efficient and hassle-free for you. So we are experts at providing support at every stage of your business, from managing statutory accounting requirements to providing financial and business services. We are here to ensure your financial operations run smoothly. So over the years, we have carefully assembled a multidisciplinary team of professionals with specialists in areas including corporate and personal taxation, corporate finance, financial management, information technology, marketing, and company secretarial. So Canor is a full suite finance and business practice. As we have grown, our range of services have grown with us, reflecting the various needs of the wide and ever-growing list of clients. So today's webinar is ideal for SME owners and managers and established entrepreneurs. It is important to note that the information contained in this webinar is for general information purposes only. For specific advice related to your business, you should always consult directly with your accountant. And if you do not have an accountant, we'd be happy to support you. I would like to encourage your participation during the webinar, so please utilize the Q&A or chat function to ask any questions you have for Larissa throughout the session. So the agenda for today, so we'll begin with a brief overview of four key areas crucial for business growth: hiring employees, financing, profitability, and compliance. Next, we'll introduce strategies to effectively navigate these areas as you expand your business. You'll learn essential steps to ensure sustainable growth for your business. And finally, we'll discuss the importance of partnering with a professional to support your business growth journey. So over to Larissa.
Okay, thank you, Joanne, and good morning again, everybody. So just as Joanne has said, this is a Q&A type of a webinar. So
Mhm.
if you do have any questions or any comments, please do utilize the chat or the Q&A function. I'm happy to take any questions you have. This is designed as a high-level discussion. So the idea is that we will give you some tips and hopefully some ideas and directions around challenges and how to overcome challenges as your business grows. But it's not designed to be advisory, and it's not specific to your business because every business is different. And every individual who runs every business is different. So if you do have any specific questions, please do refer to your advisor. And as Joanne said, if you don't have an advisor, we would be happy to talk to you. Okay, so the first area we're going to look at is operational growth and hiring employees for long-term success. Now, challenges that businesses face today. We are in an economy of full employment. That means that talent is very limited in the economy right now. All businesses will give feedback that they have challenges recruiting the right employee, retaining the right employees. And this has always been a challenge, you know. It's not, it's although the full employment aspect does make it worse. I remember speaking to businesses 15, 20 years ago, and everybody would always have the same issue. You know, getting good people is really difficult. So not only is it challenging to get the right people, it's also challenging to figure out, okay, when is the right time to hire people, because you kind of need to have the right people in your business ahead of when you need them, in advance of the challenges that come. Because if you go start looking for employees when you face challenges, it sometimes can take some time, and it can be quite critical in terms of timing. So the importance of timing and hiring decisions is really important. There's a lot of things that you can forecast, that you can see. There's always issues that you can't see, and that's fine. That's the nature of business. For those issues that you can see, so I mean, you know a certain amount of workload that's coming based on your projections. So if you do cash flow projections or budget projections, you have a good idea of what business looks like over the next 12 months. And this, by the way, this time of year in December is a really good time to do this, because as you're hopefully winding down for a Christmas break, you can look ahead to 2025 and try to figure out what's the seasonality in the business, and what's my projected workload going to be, what's my projected revenue going to be, and what's the overall business objectives. And then you figure out, okay, who are you likely to need to meet those objectives. And really the challenge is breaking down the requirements into senior hires and maybe the senior hires. It's always a big risk for a small business in particular to take on a senior hire. It's obviously a risk in terms of cost. It's obviously a risk also in terms of, you know, will this work out? Because it's one thing finding the cash to pay for a senior team member, but then you have to make an investment of maybe 6 months or maybe 12 months before you actually are happy that that hire is working out. And how do you reconcile that yourself? Um, the challenges around hiring senior members of the team, though, are very much offset against the benefits that they bring to the business as the business grows. So working out the type of person you need, whether they are revenue generating or not, and revenue generation employees are very easy for the business owner to satisfy themselves that it's a good idea to hire. Because if you hire a revenue generation employee, that goes straight to creating revenue for the business. So the benefit, the profit goes straight to the bottom line. If you hire a non-revenue generation employee, so somebody like maybe a senior hire, in particular senior hire, or maybe admin operational type talent, then they don't necessarily impact revenue straight away. So that is much more of an investment, and that is down to hiring employees for long-term success and setting up structures within the business to make sure that you can meet your business objectives. So some things to think about whenever you are considering hiring. Joanne, if you can move on to the next slide there, please. Thank you. So if you are hiring employees for long-term success, and really as you grow your business, you have to think about the structure of the business and how best you can structure the team for long-term success. There are, by the way, there is help if this is a question that you have within your business right now. If you are a local enterprise office client or an enterprise Ireland client, for example, you can get consultancy help in this area, and it can be really useful to look at the organization structure, to map it out, what it currently is now, and what you want the structure to be, and potentially what the structure should be in 3 years or 5 years' time. And that can really help you develop a plan to get from current state to where you want to be in the future. Um, the consultancy that's out there will pay, I think, if you're an Enterprise Ireland client, you can get about 800 a day to pay for a consultant in that area. So certainly worthwhile considering. Okay, so things to consider: proactive workplace planning, looking out at what you need. I mentioned this already, looking out at what you need, when you need it, and the type of talent that you need. Analyzing your revenue projections. This will come up a few times over the next hour or so. The importance of looking forward, the importance of having good management information and good projections, and the importance of comparing your projections to your actuals as you move through the financial year. It's only by understanding those numbers can you actually make decisions in real time for the business. Aligning hiring needs with anticipated business growth very much related to workplace planning. You always have to hire ahead of growth. Really, if you anticipate that you have a busy summertime, for example, you're really hiring at the start of spring to allow that hire to come in, be onboarded, and be up to speed so that they can contribute to the business when you need them. Leveraging technology and partnering with professionals that help to streamline operations and mitigate risks. Now, it depends on the size of your business and the type of industry you're in. That will really determine how your business is structured. But if you have a larger team, you will have an operations function within the business, and that operations function will be either internal or perhaps you're going to outsource that to a provider that will help you structure the business. Either way, you'll be using technology to help you to do that and to help you to streamline your operations.
Thank you, Larissa. What are the main differences between debt and equity funding, including traditional loans, venture capital, angel investors, crowdfunding, and grants, and how can businesses choose the most appropriate option for their needs?
Okay, so if we moving on to finance and growth, then
Mhm.
if you are looking at funding options for business expansion, this is the biggest area in my experience where business owners struggle. It's how to grow the business from a funding perspective. How do you access capital to grow? Because a lack of capital and a lack of cash can really hold back the growth within the business. And it can actually strangle the business. I mean, anybody on the call that has cash flow problems in the past or currently, it can really be, it's a massive limiting factor in terms of growth because the business owner can't think of anything else. All they can think about is how am I going to pay the bills? How am I going to pay the wages? So, first of all, just to explain what the different types of funding are. Um, First one there is debt. Okay, so debt funding is very straightforward. It's essentially the company or the business takes on a debt from a funding provider. So that could be a bank or another finance house, but you receive a loan of some type, and that loan could have, that loan will have to be repaid, and it will more than likely have an interest rate attached to it. So if you are, and debt is a really good way of funding the business. It's a really valid option. You just have to look at the cost of the debt. So how much is the interest rate that you're being charged? And your advisors will help you navigate the various different options out there and the various different interest rates that are available from traditional banks right through to corporate finance and all of the options in between. The interest rates can vary massively from one to the other. So it's really worthwhile spending your time understanding what the cost of debt is. Now, depends on the type of business that you have. It might be, you might have no choice. You mightn't be able to get a loan, for example, from a traditional pillar bank, so you may have no choice but to go to get a loan from another funding house. And that would be very common in types of businesses which would not have security. So say, for example, in the type of business like ours, we don't have any buildings or capital assets as such. So it's difficult for a pillar bank to fund a business like that. And the same if you're a startup. Startups traditionally find it very difficult to get debt funding because they've got no track record. And banks are very risk averse in that way. They want to be, as sure as they can be that they're going to get repaid, and therefore they're much likely to loan to lower risk options. So if you are in the position where you need to raise money, debt may not be an option for you. Although it's a very valid option as the business grows. Perhaps if you're in startup, it may not be possible for you to raise debt unless you're going to raise it personally. Some business owners do that. It is possible to get a personal loan, for example, and then for you to put that personal loan into the business. That's absolutely valid. However, if you have ruled out debt or you feel that it's not the right path for you right now, you may consider equity. And what equity is essentially giving a slice of your business to another party. So if you think about the shareholding of your business, let's say, for example, you as the business owner, you own 100% of the shares. If you bring in an equity investor, you are giving a slice of that equity away. And equity investors take many forms. Some of them are listed there: venture capital, angel investors, and crowdfunding. Angel investors, just to highlight it, angel investors will tend to come into the business at the very start of a business journey. They're more likely to take on a high risk venture. They're more likely to invest smaller amounts of money. So you may have a group of angels that come together in the initial stages of your business to invest, and you may negotiate a percentage of equity that you give to them. Venture capital can also come in very early. They're also they have a bit higher appetite for risk. And they're essentially looking to invest in your business, and they take a relatively long term view, 5, 7 years. And they really want the business to grow. So they're investing money for growth. So this is where, having those projections really come into play. Again, they take an equity percentage of your business, depending on the valuation of the business or the value that they may put on the business, um, and the value of what it may be in the future. Crowdfunding is, and there's a few crowdfunding platforms on the market right now. It's essentially where crowd comes together to invest in your business, and that can be a great option again, depending on the type of business you're in, and perhaps how innovative it could be. Again, it's a high risk one because you've got a crowd of people investing a small amount of money usually and taking a slice of equity. Finally, oh, sorry, Joanne, go ahead.
Oh no, I was just going to ask a question, Larissa. So
Sure.
say if you are getting ready for investment and you are giving away a piece of your business, who is the best person to speak to there about the right amount to give away? Who would you recommend to sort of be that
Okay.
advisor to a business?
Okay, that's a great question. It depends on the stage your business is in. So let me give you some examples. If you are a larger business, so let's say, for example, you've been trading for a number of years, you've got a decent level of revenue, you've got, a decent profit, and the business is trading well, and it has a good history of growth and good history of strong numbers, let's just say. But you've decided that you want to raise money for expansion, perhaps for acquisition, maybe for investment in new products or new markets, whatever the case might be. That type of business has a much wider choice of options in terms of funding. Because you've got a good track record, the banks or similar funding houses would be an option. And likewise, equity investment would also be an option. So the challenge for the business owner then is understanding, okay, how do I know, how do I navigate my way through all the options here and what's the best for me? Now, there are loads, well, there's not loads of advisors, there are advisors who can help navigate through the different options. And there's some that are really good at understanding what the market's like and what the current options are like on the market. Essentially, you're looking for somebody like a corporate finance broker, um, and the different corporate finance brokers specialize in different sectors and in different areas of business. So it's a matter of doing a little bit of research in that area and then asking them to present you with the best options for your business. So that's if you're in growth mode, but you're a more established business and you've been around for a few years. If you're not quite there yet, so if you're in startup mode and you're pre-revenue or you have an idea and you think this is really worth investing in, then a debt option is probably not for you at that point because there's no track record. So there's very little for a debt provider to go on. It's very difficult for them to justify a business case for investing in a business like that. So for a startup company or a pre-revenue company, it's usually angels or venture capitalists that you have to go to there. Now, again, there's loads of advisors, there's loads of options in the market, much more so, I would say, for the startup than there is
Yeah.
for the scale up at this point. And there's a lot of organizations like Enterprise, like Local Enterprise Office, and there's the various networks around the country that can really help direct you in this way to the best place to go. Again, it depends on the type of business you're in because some investors will not invest in certain types of businesses, for example. So you have to be in front of the right audience. And there's loads of options in terms of pinching competitions. So I think if you're startup or if you're pre-revenue, it's about immersing yourself in those networks and in that startup community to grow your network to understand what's the best way to raise money.
Thank you,
Okay.
Larissa.
I was just going to talk for a moment about grants because I've talked about debt and I've talked about equity. But I should mention grants as well, because there are loads of grants, a lot of grants that are available for companies, no matter what the size, no matter what the industry. So I always advise clients to make sure that they're exhausting the options to them in terms of grants before going for debt and before going for equity. Now, grants can be quite small, and I mean, there is options for larger amounts of money, but they can be quite small and they can be a little bit admin heavy in terms of accessing them. They're absolutely worth it because you know they're there to help you to grow. So I would say go to grants first before you pursue a debt or equity strategy. Okay, so regardless of what funding you go for, regardless of the type of funding that is available to you, the one common thread that is the same across all methods, grants, debt, or equity, is the importance of knowing your numbers. So the importance of your numbers, no matter what stage of business you're at, it's the one thing that every investor or debt provider looks for. Um, your accounts, your management account, your management information, your budget projections, your cash flow projections. Doesn't matter what stage the company's at, doesn't matter what industry the company's in. The numbers are the way that we keep score in a business. That's how we compare our businesses to others, and that's how our supporters, our stakeholders, our funders compare our business to others. So if you don't have your numbers right, then that's what you should do first before you do anything else, is get into the habit of having your numbers right. If you're a larger business, you should be preparing management accounts anyway on a monthly or quarterly basis. So they should be ready for funders to look at whenever they need to look at them, and they should be updated on a monthly basis. Likewise for budgets and budget versus actuals and cash flow projections, they should always be produced on a monthly basis. If you are a startup or pre-revenue, then it's all about your run rate. So again, it comes back to your numbers. It's all about understanding, okay, how much money you have and how long is that money going to last. And critically for startups, if you are going for equity funding, those investors will want to see your projections out for the next number of years. So it is very, very important that you have those numbers right, and that you can speak to those numbers and you can speak about them fluidly when asked, because you know they will ask, of course they will. So if you don't have a strong bookkeeping function or finance function within your business right now, it's very hard for your advisors. If you have an accountant, it's very hard for your advisors to understand what the correct numbers are if the basics aren't right. So if you take nothing else away from today, please do take away the importance of having a strong bookkeeping function within the business. Bookkeeping function is the basics for everything else within the business. If it isn't right, then everything else will be wrong automatically. So investing in the bookkeeping function is really important. Now, if you're a startup business, the temptation can be to do that yourself. And I see that a lot where startups would do their own bookkeeping. And that's fine to a point. I mean, there's loads of great AI tools out there right now that can um, help do the bookkeeping and help update the systems seamlessly and in real time. And we should utilize all of those. However, if you find that it's causing you stress, if you find that you push it down the list of priorities, it's likely that it's not being done correctly. And it's probably a good idea to outsource that, only because it frees you up then to grow the business.
Marissa,
Okay.
oh, just a wee question here. So how can we use budgeting to align our financial planning with the overall business objectives?
Okay, so let's say, for example, you have business objectives to have a target revenue of 20 million in
Hmm.
3 years' time. Then your budget has to lead towards that 20 million. So you're essentially, if you think about if you're a startup and if you pitch a vision to an investor, or if you're a scale up and you're pitching a vision to an investor, either way, it's the same. You're painting a picture visually in a pitch for where you want to bring this company to. What the budget does, it just does the exact same thing in numbers. So that's all it does. It charts the path between where we are now and where we want to go, but it does that in numbers. So it tells us how we're going to get there year by year, quarter by quarter, month by month. And as important as budgeting is, and it is really important, I have never, ever in 20 years seen a budget that is 100% correct. It's not possible. We don't have a crystal ball. We don't know what's going to happen in the future. Therefore, that budget versus actual comparison every month gets to be really vital in managing the path towards your goals, because you can see very quickly, okay, this is what we expected to do. We did it, or we didn't do it, or we overshot, or we undershot, or whatever the case might be. But and knowledge is power. So if you know that you're going off course, you can course correct it and get back on track towards your goal. But essentially, the budget is the important step, because painting the vision is great, and drawing that picture for the investors is great. And it's what we want to do, because a lot of people think visually. So they want to see the picture, the literal picture painted of where you want to bring this business to. But the numbers are what chart that course. Okay, Joanne, did I answer that question? Okay.
That's brilliant. Thank you. And this is just a summary of the financing growth.
Okay, so look at the pros and cons of each type of funding based on your business stage. Essentially, what I would advise you to do, depending on where you're at in your stage, speak to others in your network,
Mhm.
because others within your network will also be at the current stage, or they have gone before you, so they've already grown a business. And those people are really, really helpful to understand what's the best course of action for you, because there are pros and cons to each type of funding. And what I have found is that even if you go to an advisor, very few of them are objective. You might get some that are more weighted in equity funding and others that are more weighted in debt funding. You'll get some that will tell you that equity is the most expensive form of funding, and it is, by the way. Generally speaking, equity is the most expensive form of funding. So the advice can be, okay, well, take debt, equity way, you're not giving away a lot. However, there's another opinion that will say that if you bring in equity investors, you're bringing in people who have skin in the game. You could be bringing in people who are also not only taking an equity in your business, but they're also bringing skills to the business that you don't have. Whereas a debt funder may just give you the money, expect you to pay it back, and leave it in your court to grow the business in whichever way you said you would. But your business might benefit from having different skills around the table. So it really is an individual decision. You really have to weigh up the pros and cons, but take advice. That's the best thing. Take advice from your network, take advice from those who have done it before. Obviously, take it into account your needs, the growth objectives, and the risk tolerance. I didn't actually talk about risk, so let me just focus on risk for a moment, because I mentioned risk whenever I talked about people willing to fund your business, but you also have to look at your own risk tolerance. How fast do you want to grow this business? How aggressive do you want to be? Because if you want to be very aggressive, if, for example, you're in the type of business that is quite innovative, so it's almost like a first to get there will bet, the trade sale or the higher sale or the higher valuation, then you'll need to take in a lot of finance in order to fund that growth. However, if you're in a different type of business that maybe a slower rate of growth is easier for you, or you're comfortable with that, then that demands a different type of support in terms of funding. And as I've already said, the final point there is around your financial position and your future cash flow projections. And do speak to your accountant about this, because if you are in a position where you're looking for funding, and if perhaps you don't have up-to-date management information, then start doing that first before you go looking for funding. So, because that's the first thing the funders ask for. Even before they'll meet you in person, they'll say to you, "Can you send me on your last 6 months or your last 3 months management accounts?" And if you don't have them, then it can draw out the process unnecessarily. So if you are thinking of funding through 2025, you can start that process today.
Great.
Thanks, Joanne.
And moving on then to profitable growth, Larissa, so how does a well-defined pricing strategy contribute to the success of a business, and considering approaches such as cost plus, value-based, and time-based pricing? If you can provide some examples of each strategy and how they can impact their profitability and, I suppose, client satisfaction.
Yeah, no, absolutely. Okay, so I presented on a webinar yesterday actually, and the question I asked the group was around what's the most important numbers within the business, and there was various different answers given, and they're all correct, right? Depending on where your business is at in its growth journey, different numbers become important at different times. So, you could be looking at, if you're a startup, you could be looking at your run rate on your cash burn, for example. So how quickly your bank balance is going down. If you're in growth mode, you might be looking at sales and so on and so forth. However, no matter what number you're looking at and no matter what stage your business at, your pricing strategy plays a vital role because obviously it impacts sales, obviously it impacts profit. So it's really, really important to get it right. Um, the challenge I see in businesses is that sometimes it's not an intentional strategy that's around pricing. It's more, it's sometimes something that is based on gut, based on, what the competitor is doing. So not necessarily intentional. And I think it depends on the type of business you're in. It can vary. So, say for example, if you're selling goods, if you're selling products, it's much easier to have an intentional pricing strategy because you know what you're buying in the product for. You can mark it up at a certain percentage, and you know what the selling price is. If you're in a service-based business, it's harder because sometimes the service is based on your time if you're a startup and if you're the only person in the business, or it's based on your team's time. And capturing that time correctly, understanding exactly what the cost is, can be challenging, but really informative. So if you don't do that, I would strongly advise you to hone in very carefully on how much it actually costs you to deliver your service or to produce your product, and to have a strategy around pricing. Now, there's various different pricing strategies that you can apply. There's a couple of examples here that I'll run through very quickly. So cost plus is very, very simple. Cost plus is looking at the cost that is how much it's costing you to produce your product, how much it's costing you to deliver your service, and it's adding on a margin to that, right? Um, and that's very straightforward. It's very, very basic. It's very easy to do. Value based is a bit more difficult. Value based is around you as a business owner determining the value that you bring to your customer. Value based pricing is very common in service businesses or in businesses like consultancy, for example. The business owner will form a view of the value that they're bringing, and they will charge accordingly. And then it's up to the customer to accept that or not. And time based, again, is very straightforward. It's based on the time that you or your employees put into the job, into the project, into the product. So essentially taking an hourly rate for everybody and applying that hourly rate and pricing accordingly. Another method I've already mentioned is competitive pricing. So that's essentially looking at what your competitors are charging and making sure that you're sitting either, slightly above them if you wish, slightly under them if you wish, or just alongside them. Um, with pricing strategies, it's really important to review it on a regular basis so that you know that if competitive pricing is something that you're concerned about and you're concerned about a competitor taking over and taking market share, then having a strategy around analyzing those prices on a regular basis can really help. No matter what strategy you have, you should always take into account the margin that you're making on the product that you're selling or the service that you're delivering, and making sure that you're getting a margin that's normal for your business. Gross profit margins, if you're not sure what yours should be, there's loads of information online around gross profit margin per sector and per industry. And I would encourage you to do a little bit of Googling and determine what is the margin that's appropriate for your business right now. You should find a range, and that range, and you should be somewhere in that range depending on the stage that your business is at. This is really important for loads of reasons. Apart from the fact that it lets you know that you're making sufficient profit on your goods or services, it helps you to objectively analyze and benchmark your business against others within your sector, which can be really useful because sometimes as business owners, we might be a little bit unsure about where we sit or where we should sit in terms of our pricing. But if you're not making the margin that's correct for your business, then that tells you either your pricing is too low or your cost of purchasing your products is too high. So it's a good objective way of looking at your business. Now, there's always regional variations, of course. Like something in Dublin or pork might be more expensive than something in a rural area, but in general, the general rules apply, and you should be sitting in around the average for gross profit margin. The other reason why it's so important, oh, sorry, Joanne, go ahead.
I was just going to ask around the margin. Should it vary if you're a startup or established business where you mark yourself for your margin, or what would you recommend there? Or should it always sort of sit in between the industry average?
Yeah, no, that's a good question. Thanks, Joanne. It depends. But generally speaking, I would say that I would expect a lower margin in the early years
Yeah.
of business. And I would expect as the business scales for that margin to increase. So that's why that range is so important
Mhm.
because, again, depends on the type of business you're in. If, for example, you're in a business that sells goods, you're more than likely to get better deals from suppliers the longer you are in business and the more you buy,
Mhm.
right? So that will automatically lead to an increase in margin. If you are in a service business, experience tells me that a business owner will naturally charge less as a
Mhm.
startup. And as the business matures and perhaps as confidence levels grow, then the business owner will charge more and therefore margins will increase. So my expectation would be that margins in general would increase as the business scales. Yeah.
Yeah, that makes sense. Thank you.
Okay, so the role of payment terms. Oh, sorry, before I say that, what I was going to say was the other important point on margin is the role that it plays in tax affairs, because what happens is revenue commissioners have a huge amount of data on all of our businesses, and the data that they hold now, obviously with the analytics that are available, they can compare our businesses across location, across industry, across sector, and across stage. So they can easily identify those businesses that are, that maybe margins are higher than the industry average or margins are lower than the industry average. So it's important to bear that in mind. And if you have conversations with your accountants and if your margin is perhaps out of kilter with what they would expect to see, then there will be a conversation around why and what you can do to bring it back into line because it can highlight the business and unnecessarily perhaps, but that's something that we would look at as advisors. Okay, so the role of payment terms and ensuring you get paid on time. We've included this because it's a discussion that happens all the time, especially well, primarily with businesses who offer credit terms. So if you're the type of, if you're in the industry, if you're in an industry that offers credit to your customers, then how do you ensure that you're getting paid on time? And what's the role that getting paid on time plays in your cash and in your cash flow? So just to illustrate this point, when if you were to raise an invoice today, so I think today's the 11th of December, and you give 30 days credit or 60 days credit, depending on your industry, you won't get paid until January or February. So it could happen that you're paying the VAT on that sale before you actually get paid. So the role of the payment terms play a massive role in working capital management, depending on the type of business you're in. It can have a negative impact on working capital because you're waiting for money to come in for a long time. And as you're waiting for that money to come in, bills have to be paid, salaries have to be paid, tax has to be paid, etc. So it's something just to bear in mind depending on what type of business you're in. Now, some tips is probably on the next slide, I would say actually, Joanne, tips around, yeah. So just to start on the tips for the payment terms first, if you are in the type of business that does give credit, make sure you're very clear in communicating what your payment terms are to customers and clients. But essentially, make sure you enforcing those payment terms, because so that you're very clear that payment is not acceptable. You would incentivize early payments for various discounts. That can work very well sometimes using software and technology like Zero, and there's other add-ons that go into Zero and other providers to automate invoicing and chasing is really critical because if you can supplement the automation with a person, that's very helpful. But the automation takes care of a lot for you. Sometimes it just takes a reminder for a customer to pay, and that reminder can very easily be done automatically. Don't worry too much about reminding customers. I do hear business owners saying that they're concerned sometimes about annoying customers whenever they're trying to get payment in. I wouldn't worry too much about that. I think it's completely acceptable for you to look to get paid, especially if you're over your credit terms. Absolutely. But other things some businesses do is to ask for payment in advance. Like if you're delivering goods, for example, um, that can be very easy if you're selling online, right? That's very normal today. But even in B2B delivery of services or goods, or in delivery of services in general, you can ask for payment up front, or you can ask for a deposit up front, or you can ask for payment to be split into two or three payments. Remember that it's your business, so you get to decide. And don't naturally fall into a trap of giving credit where you might not necessarily have to give credit. Now, there are some sectors and some companies that you're working for that you really have no choice. I mean, if you're working for the larger multiples, for example, you don't get to dictate the terms, unfortunately. So your choice is to either work with them with their terms or you don't. So if you decide to work with them and if getting paid is a challenge, then you have to be very, very careful. Back to the numbers again, be very careful on your cash flow management and your cash flow forecasting, that you're consistently looking at your cash as it comes in and that you're adjusting your cash flow position when it changes so that you can look out 3 months in advance and you can be comfortable that you have enough to make sure that the liabilities are being paid, that salaries are being paid, and that there's enough cash flow to do that. If you find that it's a little bit tight and you're not too sure, then you have time to put into place a provision like an overdraft provision, for example, or perhaps something like invoice discounting. Invoice discounting is an option that allows you to, where usually one of the banks, but there's loads of funders out there that will essentially give you what the customer owes you in advance, and naturally they'll charge an interest rate on that. But discounting allows you to get paid faster. The bank is then carrying the risk, and then the bank takes the money when the customer pays. That's a good option if you are giving a large amount of credit and that facility is impacting your working capital. So do bear that in mind if that's a concern for you. Back to the first point there, which is back to pricing. Um, so again, it's about being intentional. It's about doing a complete cost analysis, especially if you're in the service business. I can't tell you the amount of clients and discussions that I've had over the years around the cost of a service. In particular, it seems to be particularly difficult to price services accurately, including the business owner's time and including all time for the team, not just the time on delivering that particular service, but all of the tasks that go into getting the service and closing out the service. So making sure you're getting a complete picture. I actually had a conversation recently with a business owner that said they didn't want to do that. They didn't want to do that because they were afraid of what the numbers would say, and they were afraid of that they would find out that they weren't making any money on the product they were selling. And I think that's really interesting because, of course, as I've already said, knowledge is power, and knowing that information and having that knowledge can help you make the right decisions. Um, and make sure that what the slide says there is breaking down the costs into direct costs and indirect costs. That's just understanding how much of your cost base actually goes into delivering the product. That would be direct costs, and how much actually goes into function to making sure the business functions. That would be indirect costs like overheads and admin.
There is a
Oh,
question here, Larissa, but you sort of covered a few points. So, as a service-based business, we struggle with setting prices that truly reflect the value we provide, just like you said, the example you used there. Can you share some insights or examples of how a business can effectively use value-based pricing to ensure their services are valued correctly by clients? And I suppose it's hard to sort of communicate that to a client, isn't it? That it is value.
yeah, it's a really good question, and it's a really difficult one
Mm,
because what's valuable to me might not be valuable to you,
yeah.
Joanne, and vice versa. So it's the business really has to identify that they're targeting the right customers first of all, and that the business understands and can communicate the value that it's bringing to the customer. And that's really difficult. It can be trial and error, there's a
Mhm.
little bit of that in it. Um, but I do see a nervousness around value-based pricing among business owners. And I would encourage, like, value-based pricing is great. It's hard to scale though,
Mm,
but it's great for the smaller business. It's just difficult to put a process around it, and it's difficult to put a system around it because it's so different. It's so different for every customer. That's the nature of it. But I think if you do have a team, and if you're trying to train a team on value-based pricing, I think I would encourage them to trial it and to be comfortable, but maybe not getting it right,
mhm.
and be confident in the ability of the company to deliver on the value as it's set out. That's probably the best advice I
Yeah,
could give.
thank you. So just moving on to compliance considerations for growth. Larissa, what are the key compliance requirements for businesses, and how can businesses ensure they stay compliant while effectively managing their operations?
Okay, so the first of all, what I would say here is no matter what stage of business you're at, you have a business owner's responsibility cannot be outsourced. So
Mm,
all of us may use professional advisors like accountants, like bookkeepers, like company secretarial providers, but it is still our responsibility as a director of a limited company, or indeed if there's any sole traders on the call as a sole trader, it is our responsibility to make sure that our obligations are met. So we can outsource the task, but we cannot outsource the responsibility. If revenue was to conduct an audit into our business, if we were to be linked with a return, it is the business that is us ultimately that's responsible. So that's the first thing. And that's why it's so important to make sure that you're working with an advisor that you trust, that you like, and that you respect, and that has all the necessary registrations and insurance, etc. That goes without saying. But ultimately, it comes down to the business owner. So I will always advise a business owner to make sure, no matter what size your business is, that you know when your deadlines are, because they don't change, right? If you're looking out to 2025 now, the VAT return dates don't change. The PAYE filing dates don't change. Corporation tax filing dates don't change. Annual return dates, they don't change either. So make sure you know what your dates are and put them in your calendar so that you don't get any surprises. I can't tell you the amount of clients that get surprised at the VAT filing deadline that happens every 2 months on the same day. It's like we almost put it out of our minds for a month or 6 weeks or so because we don't want to know about it, and then suddenly it's a surprise. It shouldn't be a surprise. It happens, all the time at the same time. So that's what I would advise. If you don't know what those dates are, find out and put them in your diary. There's just simply no excuse for not knowing, and there's no excuse for being surprised. Um, you should never get a surprise phone call from your accountant. You should never get a call that says, you owe tax today or you owe tax next week. If you do, then there's something wrong with your own calendar, because you should have those dates in your calendar. And you also should have received an email or a call prior to the filing deadline. So if you don't have them in your diary for 2025, or you can't round them off the top of your head, then make sure you put them in there. So, key compliance requirements. If you are a limited company and if you're registered for VAT, you will have a VAT filing deadline every 2 months. You will have a PAYE obligation every month if you are an employer. A limited company files one set of accounts on an annual basis, but files them to two different organisations. So we file them directly with revenue commissioners, and we file them with the company's registration office. They're both slightly different in terms of the type of accounts that are filed. For example, the company's registration office get a summary version of your accounts. And just in case you are a director of a limited company and you don't know this, the company's registration office, everything that's filed on there is a matter of public record. So there's a few 100,000 limited companies in Ireland at the moment, and each of them, all of the records, the directors, the shareholders, the company secretaries, etc., are all held on that database. And anybody can go online and view who the director of your limited company is, who the secretary is, who the shareholders are, etc. And they can download your accounts. And if you're in the type of business where, for example, your competitors might be interested in your performance, or your suppliers might be interested in your performance, or indeed your customers might be interested, they can log on and they can download your accounts. And although they only get a summary version, they they never, if they can read a balance sheet, they will have a fair idea of how the business is performing. So that's good to know if you didn't know that already. If you're a sole trader, you will only file with revenue commissioners, and they're not a matter of public record. So you don't have to worry about that. It's just if you're a limited company, then all the information is online and available for anybody that would want to see it. Um, if you, in terms of the tax filing deadlines, the corporation tax is due about 9 months after the year end. But I always say, whenever I talk about compliance to business owners, I always say that compliance is what you have to do, right? I mean, there's no question. You have to file your tax returns, you have to file your accounts. But actually, it's not the most important part in terms of the numbers that run your business. Because when you go to sit down with your accountant, which a lot of you will be doing probably in the early stages of 2025, looking back at 2024, you're actually, you're looking back, you're looking in the rear view mirror. So although it's important and you have to get the tax right and, it's important to pay the right amount of tax, absolutely, you are looking back at performance, and that's not necessarily helping you run the business today or run the business into the future. So although annual compliance is important and we have to get our tax right, what is much more important in terms of running the business is the monthly management information that you produce in terms of management accounts, budgets, etc., that really help you make decisions today and into the future. Now, in saying that, compliance is obviously very important. If you don't comply, if you don't get it right, well, for revenue commissioners will fine you a percentage of the tax that you are due to pay, and that can get quite hefty. If you are under an audit situation with revenue, so if revenue come and into your business and look through records, if there is an underpayment of tax or VAT or payroll as a result of that, then there will be interest and penalties added on there as well. If you are a company, there are additional penalties for non-filing. Now, the challenge with limited companies is that the annual return that's filed every year, if you miss that, you get fined €100 and then €3 a day for every day that you miss, up to a maximum of about €1,200. But the big challenge for limited companies is that if you continue to not to file your accounts, then the company can be struck off. CRO can strike off the company, which means the company no longer exists. And that can be really difficult to get the company reinstated if you have to. So say, for example, if the company owns assets, or if the company has money in its bank account, then it will no longer exist if the company is struck off. So if you want to sell the assets or get access to the cash in the bank, you will have to reinstate the company. And that can take a lot of time, and it can be very expensive as well for you as an individual and for the company. So it's much easier to keep the company, to make sure the company is compliant. And keeping a business compliant across all areas is, as I said, the very basics of what you have to do. If you everything else is important, and probably much more important, as I said, in terms of running the business day. Compliance is the basics. And all of you, I'm sure, if you don't have an accountant, or you might be looking for an accountant, this is where the accountant can really help. They'll make sure that your business is compliant and that the deadlines are met. This is what statutory accountants do really well. We're very focused on deadlines, so we're very focused on making sure that the business does not get into difficulty or does not get into trouble. So if you don't have an accountant, then I would advise you that this is where accountants can really come into their own. Because even though you should know what that deadline is, they will really help you meet that deadline and make sure that you remain compliant.
Leslie, you mentioned like putting the dates into your diary to ensure that you're getting no surprises. But I suppose as businesses are growing and they want to be proactive with compliance, is there any other sort of strategies that you would recommend to avoiding last minute scrambles or oversights on those deadlines coming up to them to be prepared for them as well?
Yeah, so the obviously putting the dates in the diaries, I think is
Mhm.
really important,
Yeah.
just to get an understanding. And as I said, they don't change.
Hmm.
But the deadline is the last date, right?
Yeah.
So I mean, you don't want to open your diary on a Monday and find out that there's
Mhm.
something due today. Like that's not the position
Yeah.
that you want to be in. The secret with compliance, as with anything else in business, is to be prepared. So okay, so we've already written it there. We cleared the calendar. That's great. Making sure that everything is done early, so that nothing is done last minute. So if you have, built into the annual calendar when you want your accounts done. So say, for example, your year end is the 31st of December. Now, your accounts are probably not due to be submitted until next September. Okay. So you've got 9 months, which is loads of time, right? Except, in the busyness of life, those 9 months go very fast. You don't want to be preparing your accounts in September. You don't want to be talking to your accountant in September because they're busy with everybody else. And, it's last minute. And if there's a tax bill, it can be very difficult and very stressful. You want to be doing your accounts early in the year. So gathering information together in January, meeting the accountant in January or February, and making sure that you're very clear in communication to your accountant when you want your accounts done. Because remember, they're the service provider. So if you say to them, I want my accounts done by Easter, for example, then you've got plenty of time. So making sure it's done nice and early. But essentially, Joanne, it's the management information that is delivered to the business through the year that actually helps you be prepared. Because
Yeah.
even if you haven't got your accounts done in January, February, your system will tell you if you've made money. You'll know from looking at your numbers every month if you're making money. So you can prepare for a tax bill and you've got 9 months or 10 months then to make sure that you've got the cash set aside for a tax bill that's coming. Um, Outsourcing compliance tasks to professionals. Look, I think we're going to say this, Joanne, because we are accountants, but
Yeah.
it's, to me, whenever you run a business, you delegate as much as you possibly can. The more that you delegate, the more time and headspace you have for focusing on growing the business and creating revenue within the business. Compliance is a side of the business that, yes, you have to be aware of because it's your responsibility, but you absolutely should outsource the task. And accounting software is in there as well because accounting software helps you with the management information. So as I said earlier, you get your bookkeeping right. Your bookkeeping is the foundation. You use accounting software to do that. It delivers management information, and the management information delivers the statutory accounts. So one leads to the other, and it's very much a building block rather than a statutory process that's done at the end of the year, which nobody wants to be in that position. So, Joanne, that's just some tips.
That's great. And then finally, what happens if I miss an annual return, which you've sort of touched on already anyway?
Yeah, and the reason why we have this in here is just
Yeah.
because we see it happen a lot where annual returns are missed unnecessarily. Like, silly things with, if business owners are on holidays, for example, so they can't return a signed form. It's the system doesn't make it easy for us sometimes because the page has to be wet signed and it can just be a little bit of an admin nightmare sometimes. So if you do miss an annual return, as I've said already, there is a €100 fine and there's daily fines of €3 up to a maximum amount of about €1,200. You're then subject to a statutory audit for 2 years, which can be a bit of a cost nightmare. So, the lesson here is have it in your diary so that you don't miss your annual return.
Great. Thank you, Larissa, for that. So your feedback is valuable to us. So it not only helps us improve our webinars, but also allows others to discover the same value you experienced today. So if you found today's webinar insightful and believe others would too, please take a few minutes to leave a Google review and I'll just pop in the link in the chat. Thank you very much.
Joanne, there's a question there.
Oh, sorry.
So,
Yes.
yeah,
Yeah.
no problem.
Okay.
I'll
Yeah.
read it out. It says, hi, is it mandatory for a company to have an accountant or can it just use accounting software for this purpose? So that's from Tiago. Tiago, I hope I'm pronouncing your name correctly. Great question. It is absolutely not mandatory for a company to have an accountant. It is not necessary. It is not mandated in any way. You can absolutely do it yourself. You can use accounting software. You can file your tax return on revenue yourself. This question came up in another webinar that I did yesterday as well. Interestingly enough, it's not mandatory. I would always advise you to have an accountant, and I would say that, of course, because we are accountants. But the accountant should, at the very least, save you fees in terms of tax saving. Now, that might not be the case if you don't pay any tax. If you're a startup business and you're pre-revenue, for example, you're just looking at it from a compliance perspective. It might not be a tax efficiency issue, which is fine. But no, there's absolutely no need to have an accountant if you feel that you don't need one, Tiago.
Thank you, Larissa. Just on the next slide is just introducing you to a webinar that you might also be an interest to you. So it's discovering often overlooked areas in company accounts that can result in significant tax savings and learn how to make informed financial decisions. So Tom, Head of Accountant, will host that webinar. So we'll share the link in our follow-up email on that one. So just to give a little overview of the services that we can offer to support the various areas, including company formation, company secretarial services, annual accounting compliance, year-end services, as well as online bookkeeping and VAT services. So if you have any further questions or interested in learning more about our services, please don't hesitate to reach out to us via email, hello@canor.com, or calling us directly on 01905 9364, or on our website. You can call us directly from a wee call widget on the bottom of the screen. So thank you to everyone for your participation, and to you, Larissa, for sharing your valuable expertise and facilitating the Q&A session. A recording of the webinar will be shared to all attendees, but if you do have any further questions or interested in learning more about our services, do reach out, and the information there is on the screen. So thank you, everyone. Have a lovely day. Thank you, Larissa.
Thank you, everyone. Have a great day.
Thank
And a
you.
happy Christmas.
And happy
Bye-bye.
Christmas. Yes.
And happy Christmas or happy holidays.
Yes.
Thanks all. Bye-bye.
Thank
Bye-bye.
you. Bye-bye.